Liquidity analysis is the essential part of trading Forex, gold, or any other market. Your ability to identify and differentiate high liquidity and low liquidity zones is crucial for spotting profitable trading setups. In this video, we'll go through important supply and demand basics. You will learn how to measure a concentration of market liquidity and orders on different price levels. Take notes and let's get started. Let me start with explaining what I mean by the market liquidity. The orders of the market participants are not equally distributed among different price levels. While some levels will accumulate the liquidity, some price levels will lack that. One of the proven and the most efficient ways to analyze the market liquidity is based on candlestick and price action analysis. One of the most evident signals of a high concentration of liquidity is the formation of multiple long wicks within the same area. Long wicks will signify a dense participation of buyers and sellers. It will mean high market efficiency and that the price levels within the wicks were traded by the buyers and by the sellers. Multiple candles pushing up to roughly the same high, each leaving a long upper wick, will signify a strong concentration of supply and inability of the buyers to break through. These upper wicks will compose a high liquidity zone. Learn Smart Money Concepts trading with my book. Get the essential SMC trading basics and the complete trading strategy. For more info, check the link in the description below. The book is also available on Amazon. Multiple candles dropping to roughly the same low, each leaving a long lower wick and then closing higher, will signify a strong concentration of demand and inability of the sellers to break through. This lower wicks will compose a high liquidity demand zone. Price action analysis will help you identify high liquidity zones too. The levels or the zones from where strong price movements initiate will indicate the concentration of liquidity. An area or a level from where a rapid bullish movement started will signify a strong concentration of demand, because that level or area contained enough orders to absorb all the selling pressure and then push the price upward rapidly. We can spot such a demand cluster on a euro-dollar pair, where first the market was falling sharply, but reaching a significant demand cluster, the market reversed and started to grow rapidly. An area or a price level from where a strong bearish movement started will suggest a strong concentration of supply, because that area or level contained enough selling orders to absorb the entire buying pressure and then push the price downward rapidly. And here in a pound-dollar pair, we see such a high liquidity supply cluster, where first pound-dollar pair was rising, and after the test of that liquidity cluster, the market reversed and dropped sharply. Now let me explain how to identify low liquidity zones easily, because that will be the zones to avoid trading, while high liquidity zones will be the best places to trade from. Strong bullish or bearish candles with tiny or no wicks will be a perfect indicator of a low liquidity. High momentum bullish candles with little or no wicks will signify a clear dominance of the buyers with a very low presence of the sellers. High momentum bearish candles with little or no wicks will signify a clear dominance of the sellers with a very limited buyers participation. I found a great example of a low liquidity zone on a Euro-CAD pair. The price formed a high momentum bullish candle with tiny wicks, signifying a very high buying pressure and the absence of supply. I suggest not trading when the price enters that zone. I see a great example of a low liquidity zone on a dollar-yen pair. These two bearish candles signify a clear selling imbalance, very low participation of the buyers, and a complete market inefficiency. Such a zone we should strictly avoid trading. Now let me show you how a complete liquidity analysis should look like. On a pound-CAD pair, I identified several high liquidity zones and several low liquidity zones. Blue zones are high liquidity zones and gray zones are low liquidity zones. The lowest high liquidity zone is based on multiple wicks that the price formed. All these wicks suggest the concentration of demand here. The second zone is price action based. We can see that in the recent past the price dropped strongly from that area. Then we have a high liquidity zone right here. It is based on multiple wicks, and we may assume that the market demand concentrates within that area. Then right here we have a high liquidity zone based on the market supply concentration. We can see that many times the zone was respected as the supply zone. We can see that now the price violated that, and after a breakout it simply turns into a demand zone. And lastly, we have a significant high liquidity zone here. It is price action based, and just recently we saw a strong bearish reversal from that zone. Gray zones are low liquidity zones, and these zones are based on high momentum bullish or bearish candles with tiny wicks. Blue high liquidity zones will provide the safest zones for trading, while gray low liquidity zones will be the zones to avoid trading within. Price action and candlestick analysis are powerful tools for measuring market liquidity on different price levels. It will help you better orient yourself and make more accurate predictions trading Forex or any other market. Let me know in the comment section if you have any questions. Learn Smart Money Concepts trading with my book. For more info, check the link in the description below. Also, traders, please watch my other videos.